Welcome everyone to another episode of Supply Chain Unchained. This is a podcast where we unpack the entire supply chain all the way from freight forwarding, supply side, all the way to the end consumer. Today I'm joined by someone who is an expert on freight pricing and how freight is priced in the market. Johnson Leung of Linerlytica. Johnson is joining us all the way from Hong Kong. Thank you for joining us, Johnson. I really appreciate your time. Johnson, just before we actually get started into the topic of today's episode, which is essentially the anatomy of a freight rate, before we do that, maybe let's give the guests some insight into your background across shipping lines, financial, hedge funds, JP Morgan. If you can, give the viewers just a background of who you are and your career so far.
Yeah, I have about 30 years career up to this point. It's still going. So the first 10 years, I was in the container shipping industry. Start as an apprentice in Maersk. That kind of put me through a number of different job functions. Pricing was one of them. So one of the jobs I did when I was an apprentice in Maersk. And then the last 20 years, I become an analyst. I start my analyst career in the stock market, so with JP Morgan, and then I went to a hedge fund, and then I went to another US bank. I started Linerlytica about 6 years ago with a couple other partners. So my career interest has been always about where the freight rates are heading, and what drive it. So I did some pricing, right? So in Maersk, there was pricing for outbound shipment out of East Coast South America to Far East and Europe. But the idea of pricing for every route is similar. So we can talk about it. And then my role as an analyst, because in the finance world, usually the analysts, especially like for equity research, we usually, stock market is what I specialize in. I cover primarily the shipping stocks, and my angles are really the container shipping stocks. So to trade those stocks or advise on the buy and sell that kind of stocks. So my main job's about predicting where the freight rate is heading, and what drive it. And then in Linerlytica, which kind of extension of what I was doing in the finance market. So we can touch upon about in the following questions. It's always about freight rates. So that's really what my career is.
When you mean container shipping stocks, you mean the stock price of the liners, the shipping liners, is that right?
Yeah, I advise and trade the typical one was China COSCO, Maersk, Hapag-Lloyd, Sims, the like back then the NOLs in Singapore, HMM, the Taiwanese, Wanhai, Yangming, Evergreen. So those actually what I've been making a living on the last 20 years.
Right. So so if you're trading those stocks, you need to know what makes them tick and what means, good performance for them versus bad performance. And I guess the freight rate is part of that, right?
Yeah. Usually the stock up and down depending on their earnings, right? And their earnings is driven by the freight rate.
If I'm a supply chain manager, I'm talking to my freight forwarder, or maybe I'm a BCO. I talk to the shipping line directly, and I'm looking at a freight rate. There's obviously a lot that goes into that. Can we maybe start off breaking down the building blocks of what makes up a freight rate?
So I tend to look at it break down the cost into I would say 4 components. So one is the first things we need to really know is the local charges. So as a shipper, you also need to know, because usually you get the quotation, right? So they usually give you ocean freight plus the local charges. So sometimes the ocean freight, they may have some surcharge come with it, like the bunker recently. But usually, sometimes you also get the all-in for ocean. But usually the local charge is always separate. So the ocean, sometimes they lump it together, sometimes they spell it out. But the local is always a separate component. Mainly because the local charges usually come with a THC that you pay separately. So that one is
terminal handling charges.
the terminal handling charges, yes. So that's one areas. And then when you look at the thing about freight rate also, so the freight rate conventionally is for all the indexes that we follow, so the Shanghai Container Freight Index, or the Shanetta, or the freight toll, jewelry, all these freight index. Usually they are all all in for the ocean part, but does not include the TXC. So that's what. So this is one component that you have to think of it separately. Yeah, some of the trades for Trans-Pacific, they're included in the ocean freight. The destinations in the US TXC, they included into it. So that one's included, but usually it's a separate. So the one is this cost usually being compensated by a separate component, not the freight rate, is a TXC. Another angle to look at it is this one is a truly variable. So they come to my second component. So one is the TXC, sometimes local charges, sometimes included, sometimes not included. So assuming it's not included, so then the second component, so what we talk about is the variable. So by variable, as a customer, you need to understand is, what you need to understand is that when the liners or the accountant, the finance people, when they consider it as a variable, meaning this cost will only be incurred when the liners accept your cargo. So if they don't accept your cargo, they don't have this cost. So this cost is usually the empty repositioning. If they take your cargo, so like let's say you're in the front haul, then they need to send the empty container back. So that will come with basically the entire voyage cost for the container, and also the terminal handling of this container, because no one pay for the empty container handling. So that will be pricing into your freight rate. So that is the truly variable part. Then this part is super sticky. Doesn't matter, so the market good or not, then you find that the liner will have to find a way to get the compensation from you for this cost, because they don't have this cost if they don't take your cargo. So that's thinking behind it. So that's the second component. So the third, so I would call it what we consider as a semi-variable. So they are what we call the voyage cost. So the voyage cost, including the bunker, so that's a huge component now. So and also if they go to some canal like Suez or Panama, then the canal tolls they have to be better integrated. And then the third component, so for this voyage cost, is the port charges. So the port charges are different from the terminal handling. Terminal handling, you pay to the terminal operator. Yes, like the Hutchison, Jewelry, those people. So that's what you pay to it. Yeah. So, but the port charges usually is paid to the port authority. When a ship port, so there's another component. Usually it's a couple tens of thousands, so or even more. So they pay to the port authority, some sort of tax. So that's also a voyage cost. So this voyage cost, I call it semi-variable in the sense that it's not really variable. That doesn't matter if the liner take your cargo or not. They have this cost because the vessel is sailing. It's a light. So if the business getting really bad, they will cancel a voyage. So then they won't have this cost. So that's why I call it semi-variable. So this component, when they do pricing, they may or may not being a factor into the pricing.
When you say semi-variable, basically what I'm hearing is there's a big expense for them not taking on that cost, if that makes sense. In order to get rid of the port charges, they have to cancel the whole voyage.
Yes. But then if the ship's going anyway, so let's say my ship, I'm not at a point that I need to consider if I cancel a voyage or not. Let's say I'm like 50% utilized. Now my bookings will provide me 50% or 60% utilized. I get sufficient cargo base. So I'm considering how to price the cargo that you send to me. Then I may not consider. So if the market really bad, I may not consider this a voyage cost.
Right.
What I need you to pay for me is at least what you pay to me is at least can cover my empty repositioning, bring the cargo back to Australia. So I'm back to origin. So that the voyage cost may not be factored into my pricing. But in the event that I'm to a point that I need to consider if I go on a voyage or cancel it, then that's the time that I think I will see, can you pay for my voyage? Because when it's 50-60% full, maybe I think that, okay, a lot of other cargo already cover my basic voyage cost. So what I consider for you is if you can pay for the empty positioning when I take your cargo.
Right.
So that's the third component, semi-variable.
Yep.
So, and then the four components, the fixed cost. The fixed costs are the depreciation, which is basically not... Depreciation is not only about the vessel and the container boxes the liner own. Now the charter fee is also factored into the depreciation. So this one, it used to be fixed, but now it's kind of borderline, also it's kind of semi-variable.
I was going to say,
Yeah, so when they decide to charter a ship or not, then there's also a bit of in between of totally fixed or semi-variable. So, but if you really fixed costs, then that's also what we call the sunk cost. So meaning when the business is really bad, so the liner really do not need to consider these fixed costs. So now back to from the shipper's angle, right? Then you'll find it. So in the overall break-even, you'll find some resistance. The liner always want to have the total cost being covered.
Yep.
All these four components, of course, being covered. But when the business really start to really not doing so well, they may forget about the fixed cost. That's why sometimes you find, there's a quantum drop in the freight rate. So, and then that's around like 10-20%, right? So in this fixed cost. So when the business is really, they can have there's some base cargo, but to a point that the liners just want to get the incremental profit. The incremental profit is, if I take your cargo and then what you pay to me is enough for me to cover my variable, meaning the empty repositioning, I may still take your cargo. Because this ship will go anyway. So if my variable is the empty repositioning, the empty handling for the voyage, let's say it's about like couple hundred, 200, then you pay me 300, I may still take your cargo.
Right.
So that's when I priced at a point that I totally forget about the voyage cost. So that's the voyage cost is a big component. So it's between depending on the trade or the corridor. So it range also depending on the bunker price. It range between 30-40% to up to like 70-80%. They're all voyage costs. So when they do pricing, so they don't even consider voyage cost. That's really the so-called marginal pricing. So you can get some freight rates that's like 200 or even lower. So
this is just as long as I cover my empties, then I'm kind of happy.
For the liners, as long as they cover, they can put the empty back, so or whatever variable they're associated with taking your cargo. So, but then of course, there's on the assumption that the TXC is still to be paid, so that's not included.
Separate, of course.
Yeah, so because the TXC is a real variable, right? The latent TXC. So the latent TXC is if I take your cargo, I have to pay the terminal operator as a liner. So as a liner, I need to pay the terminal operator. So you need to be able to cover it. So for the short haul trade, sometimes the TXC component or the local charge component is the liner's main bread and butter, actually, not the ocean freight.
Right. So, well, I mean, even here in Australia, sometimes the local charges are just as much or more than the actual freight charges themselves. When especially when demand is high. That was going to be my next question. So, when demand is high, which of those four components gets inflated?
When demand's high, so then it's totally nothing to do with cost. Okay.
Yeah.
The cost is when demand is low. So when demand's high, so then the liner will try to test up to what point that you cannot do business.
Right.
That would be their ceiling. So and that take to, and you can look at the last 5 years. So I think what one factor that changed last 5 years is that the liners suddenly understand that the ceiling of the price could be much higher than what they
Initially
thought
thought.
before. So previously, they thought that the customers, even in a good time, the best the customers can pay maybe 2,000 for 40-footer or 3,000 for 40-footer. But during COVID, what they found out is that a larger customer can pay 10,000 without going out of business.
Crazy, isn't it?
They totally changed the volatility of the market, because now they learn that the ceiling on the pricing could be higher. So when the demand's high, there's really
Everything gets inflated.
How much that you can pay without going out of business. So then that become a big problem for a lot of shippers, because now the freight rate becomes far more volatile than before. The bottom's still the same, because the cost, there's some cost inflation over the last 4 years. From the angle, one's the loss in efficiencies in the industry. So there's a lot more port congestion, that kind of stuff. So the vessel time gets slower. So that to the voyage cost. So and then the second one is one is the cost, another one is they found that you are able to pay much higher. So then the same bottom maybe slightly higher due to
slightly higher. Yeah.
But then
the ceiling really is expanded, basically.
The upper end is much higher now than before. So that become an issue for many shippers.
The thing I'm thinking about is, with that upper ceiling, can you maybe talk through for people watching, where does a GRI fit into this, and whether a GRI will stick or not? Because that's something we talk about a lot, is GRIs coming in, whether they'll stick. So how do we, if I'm someone who's importing or export a shipper, how can I what will dictate whether that sticks or not?
Okay. So, then as a shipper, when you try to gauge how much would be your transport cost, you just have to go to study the demand and supply for all these factors. To know if the GRI can stick. So the GRI could only stick if that's really the main thing I was saying is that the utilization of the vessel. Of course, if the liners, they all have a kind of synchronized request, then they increase the chance of success in pushing through the GRI. What we have to know is the industry is in the top of the cycle, when we see that the industry doing super well, and the industry is having what we call a bloodbath from the liner's angle, meaning that the freight rate being very low. So in these two scenarios, the vessel utilization is that the gap is not very wide. Not that it's not important. It's still the single most important thing, but the margin is quite small. So that the difference for the entire industry is in the peak of the cycle, so usually the utilization up to 95%, and then the bottom of the cycle, meaning when things the freight rate being very low, things going very poorly for the liner. So the utilization maybe is 88% or 87%. So it's less than 10% of percentage point in loading. So then it defines the small gap that defines the very high freight rate that you're paying or the very low freight rate. So, but at the end of the day, it still depends very much depending on the loading. The line is super sensitive to it. So even though that it looks like the liners somehow can send signal to each other and allow each other to follow the GRI, and a lot of shippers may also suspect that there might be some collusion going on. But that legally they are not supposed to.
Correct.
So they have to be super careful, because they can pay a much bigger fine than what they could earn in a couple of voyages if they really being found having collusion going on. So I don't think the collusion among the liner work very well. Because I myself, I sit in the so-called conference before. So the East Coast South America, when I was in the line management there. So I was the representative for Maersk in those conferences. Usually, the line between themselves, they talk about price and that kind of stuff, but the collusion never works. So
Yeah.
I mean, not that they try, even better than when they're allowed to communicate directly. So that doesn't work, and now it's much harder for them to communicate. So,
well, based on what you're saying, it sounds like the market will dictate where the price should lie anyway. So there's no need to collude, because you will know where your price should sit based on how many bookings are coming through for a particular vessel.
Yes. So
essentially,
the key thing from shippers, you have to understand their utilization. So, but then that factor is not. I mean, we do have it for every voyage, but that factor is still kind of a backward-looking. So even for our data, we only know about the vessel utilization. I mean, meaning Linerlytica, up until maybe just a few hours ago. That's still backward-looking. But what really dictates the freight rate is it's not just about what happened in the last sailing. It's about the next few sailing. What will be the loading?
right.
So for those, there's another two factor as a shipper that you can pay attention to. So one is the liners are online quotation. Yeah.
Okay.
So the online quotation, although oftentimes you don't use them, you are not getting you are not paying the liner based on the online quotation. So you have your contract and so but the change in the online quotation, meaning if one liner yesterday they called 1,200, but today they called 1,100, but they're telling you that there's GRI by this weekend, and you know that it doesn't look likely.
Right.
So
so it's not about the number itself; it's about the trend, the direction of the quote.
Yes, the
which way is it going?
So that's another factor that you can get intelligence about if that GRI will stay. So the third intelligence you can also get that's also forward-looking is the so-called the actual capacities or the weekly capacity. So based on the sailing schedule. So that one is a forward-looking, right? So you can see. So like let's say for the trades, Oceania trade to the Far East countries. So every week, if you have usually have 100, some like 100,000 T or few tens of thousand TEU. So if you have to benchmark the average weekly capacity, if this coming week is getting bigger or less, and then in the next few weeks also the figure getting bigger, the weekly total capacity that you can book from all the liner, if the figure getting bigger, then you know that the GRI may be less likely. If that figure you see that doesn't change, it's very steady, then maybe that figure dropping, then maybe the GRI get a better chance to stay. So the change in actual capacity also from the sailing schedule, there's also another angle that as a shipper that you can use to gauge if a GRI will stay. So vessel utilization, the latest vessel utilization, the liners pricing behavior online, although even though that you may not use it to pay for your actual shipment. And then the third one is the real capacity, the weekly capacity.
That's good advice, and that's something that we talk to our customers about. Is we release to our customers a report that has some market intelligence on here are the blank sailings, here's the capacity over the next coming weeks.
Yes.
This is what rates have been doing, and there's a GRI coming on this day, but if the shipping lines are blanking like crazy over the next coming weeks, but there's a GRI coming, well, maybe that GRI is not likely to stick, because otherwise why would you need a blank, right?
Yes.
Interesting. So that kind of leads me to my kind of next point. I'm obviously as an importer or a shipper, I can't control what happens, where the rates go, and all these kind of things. But what might I be able to do if I'm working with a freight forwarder, like many of our customers would be? What can I do in that relationship to kind of predict, where the market will go?
Okay, so I think the premises for a lot of the cargo owners, they need to know, in how to manage the freight rate volatility is. So the freight rates are actually not predictable. You can get I'm speaking from after doing it for 20 years. And that's really my full-time gig. But you have to accept that it's not predictable. So you can get the best intelligence, get a hunch. So you may get it 50% of the time right. So, but you still run the risk of there's another 50% chance that you may get it wrong. So the first things I think the most favorable strategy for any cargo owner is to ask like forwarder like yourself or the liners or who provide the transportation service to ask for a fixed cost, like sort of an annual contract or a contract. So that's the best way to do. But then of course I know that the problem for many shippers is they're also not willing to commit their volume, right? So but you need to. So as long as the freight cost is below below your budget, meaning for your shipments, you intend to make 10% margin. If the freight cost does not eat into your 10% profit margin, I think these are good freight costs. So if you try to gamble that you may get even lower, then the flip side of it is you can end up paying higher as well. So getting a contract, getting a stabilized fixed rate that you can still make a profit out of your shipment, I think that's the best strategy. But then, that they come to another point about the industry. So usually the commitments have to come by, right? I know. But I think there's one thing the industry need to fix. I just find it, that the recent years development in the industry is you're getting more and more the so-called index link contract, right? So I have attended some event where the promotion of index link contract and the use of a fixed future, the hedge, it come together in the same event. I think that's such an irony for industry.
one of the same.
You're promoting people to embrace the floating rate, and in the other hand, you know that the users, the industry participants, they all want to have a fixed rate, and then you sell the fixed future trading. That's fantastic. But fixed rate is a contract. I think it's the best. But I know that's very difficult to negotiate. That's why many players elect into the floating fixed rate. And then the floating fixed rate, when you go to the route of floating fixed rate, then you go back to what we have just talked about at the previous couple of questions. Then you need to improve your intelligence. Fixed rate is not predictable, but then when you're forced to predict, you have to gather all the facts that's available.
Right.
Well, you cannot talking to a liner or forwarder that the liner and forwarder being more intelligent than you.
Right.
If there's a lot of information that you can gather, there's a fact that has happened already. If you don't know, then that's your failure.
Yeah. So you're saying the freight rates aren't predictable by nature, but that doesn't mean you should not try and at least come up with some kind of prediction or assessment.
Yes, exactly. Because when you are in a position that you cannot get any fixed offer from anyone, you cannot get a contract, your volume too small, no one talk to you about any contract, then at least you should do sufficient homework on all the demand and supply factor to drive the freight rate. Unless if the freight costs, it doesn't matter how it doesn't matter to you, then that's another story. But I presume now, because of volatility, it matters to everyone.
You might not be able to get a fixed rate. Freight rates aren't predictable by nature, but that doesn't mean that you should not try and predict them. And you should educate yourself so that you get as much intelligence as you can to know where they might land. And correct me if I'm wrong, but it sounds like you might be able to predict if not the freight rate itself, the number, you can at least predict the direction they're going in. Is that right?
Yes, sometimes when the factual stuff is enough, sometimes you may still be able to know, okay, for this weekend or next week, the freight rate will go up or not. You still have 50% chance, right? You don't do your homework, you may even less. Or the other side will totally take advantage of the fact that you don't know what's going on.
It's a bit like that. So And I think with it's not to get too philosophical. If any job that you have, it's on you to educate yourself about, the marketplace, what's going on in your industry, just to be aware, as a good operator, right? And I'll plug, just while we're on this, I'll plug this again. We release market intelligence to our customers. If you subscribe to our mailing list, I'll put a link in the description of this episode below, where you can subscribe. Every month we release a report with market intelligence on these data points that you're talking about, Johnson. I guess that kind of wraps up the discussion around the rates, I think, quite nicely. What I did want to touch on while we have you here, can you tell us a little bit about Linerlytica? Because you guys have some market intelligence. I know you have some tools available for free and some for subscription as well. Is that right?
Yes. So thanks for asking that. For Linerlytica, we produce the kind of supply and demand factors or data that we believe are the driver for the container freight rate. So the stuff that we produce are like, for example, the port congestion situation, the weekly capacity for different routes that I talked about. There's one of the factors that we really should watch. So about the capacity, the supply side. So the supply side is not about this year we have a so and so new vessel coming in, the 4% growth. You cannot draw a conclusion from that, especially on the day-to-day basis where we're looking at that's too macro. So we have to consider about for our corridors, for the market that we are in, if there would be more capacity or less capacity. So we produce those, the weekly capacity. We also track the vessels utilization, the voyage by voyage, up until a few hours ago. So we get that nearly the live data. So we create, we check all these kind of mainly supply side data. The utilization give you a bit of the demand side. So we check this kind of data so to try to give people the idea about where the freight rate is heading. We track all the 7,000 container ships globally. And then we track now I think it's over 2,000 liner services everywhere. So that's what we do. The users that subscribe our data are mostly the ocean procurement managers from the shipper side, the forwarders, the pricing manager in the liners, and then some of the people who trade the fixed future and then shipping stocks, they also use our data.
Awesome. And what you guys do, it's very insightful intelligence. We use it a lot. We've got a subscription ourselves. So for anyone who is a purchaser of space on container vessels, that's a really good resource. Linerlytica.com. I think that wraps everything up. What I would like to do, Johnson, if you can, one line, if I'm a supply chain manager, just one line advice that they can take away from this episode.
Well, one line is, freight rate is not predictable. So,
I like that.
But then, but when you have no choice, you still need to maximize your level of intelligence about what to make it. Otherwise,
I like that.
Then you fail in your job.
After 20 years of predicting freight rates, we know that freight rates are not predictable. I love it.
That's takeaway.
Awesome. Thank you very much, Johnson. Really appreciate your time as always. And to those listening, don't forget to like and subscribe. We'll be back with another episode soon.
Okay, thank you for having me.
Thanks, Johnson.
Cheers.